You make around $80,000 a year. That's a solid income in America. You did what everyone told you to do. You worked hard, you saved money, you stayed out of major debt. Now you're ready to buy a house. So one night, around midnight, you open Zillow and start scrolling. Every decent house costs $400,000, $450,000, sometimes $500,000. The kitchen looks like it hasn't been updated since the early 2000s. The carpet is that strange beige color that every house seemed to have in 1997. The basement still has fake wood paneling, and somehow the listing description calls it a starter home. Then the bank tells you something confusing. You're approved. Your real estate agent smiles. Your parents ask when you're finally going to buy. So you start wondering, if everyone says you can afford it, why does it feel like something is terribly wrong? Here's the uncomfortable truth. You probably cannot actually afford that house, not in a way that allows you to live a normal life. And the worst part? Almost nobody involved in the home buying process has any reason to tell you that. Today, we're going to do something the real estate industry hates. We're going to calculate what house your salary truly buys you. Not what the bank approves, not what a real estate agent suggests, what you can realistically afford without turning the next decade of your life into financial stress. Part 1. The brutal math of American housing. Let's start with a simple number. The median household income in the United States is roughly $83,000 per year. That's the middle of the American income distribution. Now, compare that with housing. The median home price in the U.S. is around $415,000. Think about what that means. The average household earns about $83,000, but the average home costs 5 times that amount. 5 years of your entire salary. And that's before taxes, before food, before gas, before anything. Historically, homes used to cost about 3 times annual income. That was considered normal. Today, 5 times income is standard in many markets. In expensive cities, it can be 8 to 10 times income, which means the typical American household is trying to buy homes that are priced far above what their income realistically supports. And yet, the banks keep approving mortgages. So, how does that make sense? Part 2. What banks approve versus what you can actually handle. There are 2 completely different numbers that matter when buying a house. The first is what the bank will approve. The second is what your life can actually handle. These are not the same number. Banks typically approve mortgages based on something called the debt-to-income ratio. Most lenders allow up to 43% of your gross monthly income to go toward debt payments. That includes mortgage, car payments, student loans, credit cards, all combined. But here's the part nobody explains clearly. That 43% limit is not a comfortable lifestyle recommendation. It's a risk threshold for the bank. They're basically asking, how much financial pressure can this borrower handle before they stop paying completely? It's not about your happiness. It's about minimizing default risk. Financial planners use a much more conservative rule, the 28% rule. This says housing costs should stay below 28% of your gross income. That includes mortgage payment, property taxes, homeowner's insurance, HOA fees, all housing-related costs combined. That difference between 28% and 43% is massive, and that gap is exactly where many people get trapped. Part 3. Let's run the numbers. Let's say you buy a $400,000 house. You manage to save 10% down, which is $40,000. That leaves a $360,000 mortgage. Assume a mortgage rate around 6%, which is fairly typical recently. Your monthly mortgage payment for principal and interest will be about $2,150 per month. Sounds manageable, right? Not so fast, because the mortgage is only the beginning. Now we add everything else. Property taxes could easily be $450 per month. Homeowner's insurance might run $300 per month. Because you didn't put 20% down, you'll pay private mortgage insurance, maybe $275 per month. And then there's maintenance. Homes break constantly. The general rule is 1% of the home's value per year. For a $400,000 house, that's $4,000 annually, or about $333 per month. Add everything together. Mortgage, $2,150. Taxes, $450. Insurance, $300. PMI, $275. Maintenance, $333. Your real housing cost becomes roughly $3,508 per month. That's the real number, not the $2,150 mortgage you see advertised. Part 4. The income you actually need. Now let's apply the 28% affordability rule. If housing costs $3,508 per month, your annual income should be around $150,000 per year. That's the income needed to comfortably afford that house. But remember what we said earlier. The bank might approve someone earning as little as $98,000. So there's a huge gap, about $52,000 in annual income difference between what the bank says is okay and what financial math says is safe. And here's the bigger problem. Only about 20% of American households earn $150,000 or more, which means the vast majority of Americans cannot comfortably afford a $400,000 home, even though that price is already below the national median. This isn't an opinion, it's just math. Part 5. What house poor actually looks like. Let's imagine a typical scenario. A couple earns $80,000 combined. They buy a $400,000 house because the bank approves them. Their monthly housing cost is around $3,191. After taxes, their take-home pay might be around $4,600 per month. That means housing alone takes nearly 70% of their take-home income. What's left? About $1,400. From that, they still have to pay for groceries, utilities, gas, health insurance, car payment, student loans, internet, phone bills. That budget collapses instantly. Every unexpected expense becomes a crisis. The car needs repairs, the air conditioner fails, medical bills appear. Suddenly, credit cards start filling the gap. This is what being house poor actually means. You technically own a home, but you cannot comfortably live in it. Part 6. Why your parents had it easier. Your parents probably bought their first home much earlier, and many of them assume you should be able to do the same. But the economic environment has changed dramatically. In 1980, the median home cost roughly 3 times the median income. Today, it's closer to 5 times income. That alone changes everything. But the differences go further. College tuition was dramatically cheaper decades ago. Many buyers today start their careers with tens of thousands in student loans. Car prices have exploded, healthcare costs have increased, and in many households, 2 incomes are now required just to qualify for a mortgage. Even the age of first-time buyers has shifted. The average first-time homebuyer used to be around 28 years old. Now it's around 40 years old. That's a huge change. Part 7. The hidden costs of home ownership. Most people focus on the mortgage, but the real costs of owning a home go far beyond that. Studies estimate homeowners spend over $20,000 per year in hidden costs. Things like maintenance, repairs, utilities, property taxes, insurance, internet, landscaping. Everything breaks eventually. Water heaters fail, roofs age, HVAC systems die in the middle of summer. And these repairs aren't optional, they're part of the reality of owning property. Part 8. Insurance is becoming a crisis. Another issue most buyers underestimate is homeowners insurance. Insurance costs in the U.S. have risen dramatically. In some states, premiums have increased nearly 50% in just a few years. In certain high-risk areas, insurance alone can cost thousands of dollars annually. Climate risk, natural disasters, and rebuilding costs are driving these increases. And unlike your mortgage payment, insurance costs can continue rising every year. Part 9. Why housing isn't crashing. Many buyers are waiting for a housing crash, but a major nationwide collapse is unlikely for one simple reason. Most homeowners locked in extremely low mortgage rates during recent years. Millions of Americans have mortgage rates below 4%. Many are even below 3%. If they sell their home today, they would have to buy a new house at much higher interest rates, so they stay where they are. This keeps housing supply low. Low supply keeps prices elevated. It creates a cycle that prevents prices from dropping dramatically. Part 10. Renting isn't always the wrong move. There's a popular belief that renting is throwing money away. But mathematically, that isn't always true. In many cities today, renting is actually cheaper than buying. Mortgage payments often exceed rent by a large margin. That means renting allows people to save more money or invest elsewhere. Buying only becomes financially advantageous if you stay in the property for many years. In expensive cities, the break-even point can be a decade or longer. Part 11. Your real options. If housing feels impossible right now, it doesn't mean you're failing. It means the math doesn't work in your favor yet. You still have options. One option is relocating to a lower-cost city. Income can stretch dramatically further in certain regions. Another option is buying a smaller home than you originally planned. Less house means lower financial pressure. Some people use strategies like house hacking, renting rooms or units to offset costs. And sometimes the smartest choice is simply waiting, saving more, increasing income, letting the numbers improve before making such a large commitment. The most important question isn't whether a bank will approve your mortgage. The real question is much simpler. Will owning this house actually improve your life, or will it lock you into years of financial stress? Housing decisions shape your financial future more than almost anything else, and understanding the real math behind affordability might be the most valuable lesson you ever learn. Your salary buys less house than you think. Recognizing that isn't failure, it's clarity, and clarity leads to better decisions.